Good afternoon, everybody. It's Greg Schnell. I am here with the weekly market review for December the 7th, 2019. And I missed all of November. As most people know, I was off on a cruise through the Panama Canal and really enjoyed that. Anyway, back in action, getting back into the videos and trying to get caught up. Lots happening out there, so let's get into it. First of all, to find my blogs, StockCharts.com, the articles tab, drop down menu on the right. Those three are sitting there, and then you can always hit subscribe at the bottom. And if you go to gregschnell.com, you can also find some public blogs there. Email new update at gregschnell.com, Twitter Schnell Investor, and website is gregschnell.com. The agenda today is the dip tested the lows of November. So, got into late November actually, and then all of a sudden we plummeted down. We went all the way down and tested like November 3rd or something, November 4th, that kind of date, and then rallied back out of there. So that was a pretty good rally. We have a Fed meeting coming up this week, so we could talk a little bit about that. And then the China trade talks, we have tariffs that are going to kick in on next Sunday unless they get deferred again. So it's a bit like a wiggly jello there where you push it and it moves around. But anyway, until we get more clarity on how that's going to work out. But I want to go through the breadth charts right now because they're very strong. So I think there's a lot of good information there, and from my perspective, things are holding up really well. And then if you want my full commodity review and all of that kind of stuff, you can find that over at gregschnell.com on the private investors tab over there. So, okay, let's head over to the charts here. And so what I want to show on these advanced decline lines is what you'll see here. We've been hovering around this level called 5,000 here for a while, but we're still trending up, and this is very, very strong. So as long as this is going to trend higher, that's good. The Nasdaq typically can have a weaker bias, so that's not a big deal. But what we see here is this has been trending higher, and it's been holding up at a nice high level. So everything is good there. Even the advanced decline, when you take a moving average of the advanced decline line, and in this case it's an 11 period, and just say, what's it doing? Well, it's wobbling back and forth. It's when you get these big down cycles that you want to watch for. So you get a trend break and it's going negative. We don't have that yet. So everything is still quite bullish. If anything, I would start to draw a trend line here and just see how long it could go. But if you'll notice the slope of these trend lines, it should probably borrow one from over there. So an example would be just go grab this trend line, just go grab this particular trend line here, and then you could put that up here and just say, give it that sort of angle for holding up against. So nice, and at least gives you something to work with. So that can help us in the future, just taking kind of typical slopes from history and moving it forward. Looking for the high-low data, this is still bullish. Now, one of the things we keep hoping for is this sort of bullishness. The absolute rockets up into really high levels. We're still not quite there yet, but this is still bullish, right? We're between 0 and 150 or 0 and 200. Very positive, not getting a whole bunch of negative days, so that's very important. Looking at the Nasdaq advanced decline line, one of the things on this particular chart, you can see it's a lot tighter. It's got a nice trend line, a little cleaner than that Nasdaq chart. This is the New York Composite. And what we see here is it's still holding up, and it started to look like it might break down last week, and then it just bounced right off it and took off to the upside. So still very bullish. Price is breaking out to new. I don't know if it actually got through the last January highs on the daily chart. Let me just, we'll just add another year and that'll give us the data. So we're just hovering right around the highest close. Again, this is a line chart, so it'll take the highest close. And what we want to know here is, can we break out to new highs on this? Anytime we're starting to test prior highs, always want to be just watching the market for weakness. We don't seem to have any of that right now, so everything looks pretty good there. For the high-low data, for the net new high data, what we talk about there, and that what is net new highs. So that's the number of 52-week highs today minus the number of 52-week lows today, and that gives us our net. And so we're sitting here with, again, around 100, and this chart looks a little more bullish than the Nasdaq one does. Again, not at all like this 2016-17 period, but we're still okay bullish, and no reason to kind of discount the level we're at. This is still pretty solid. And for the S&P 1500, the advanced decline line, we're nowhere near the trend line here, so we're doing very, very well, and this is obviously looking quite solid. So very comfortable with that. You know, if we continued to move up at a higher slope, then I'd probably go take the slope off this line and move it over here and put it on here. So far, we're all good, so I don't see any reason to kind of change everything up. It still looks pretty bullish out there. For the Canadian market, what we see here is we haven't really had any major momentum, and we keep watching. I would say if the energy sector could start to perk up, that would help, but it's got a long way to go to make any sort of net new highs. At least it could start in the advanced decline area. And again, what is the advanced decliner? So it takes the total number of advancers today minus the total number of decliners today and creates a number. And then on this chart down here, it's additive. We keep adding to it. And what you see here, it's just not going anywhere. This is what the daily data looks like. And we were starting to pinch down here. Now we're swinging wildly, but still haven't got any sort of momentum, barely above zero. So we're still watching this. And a trend line breakout here would be much more bullish. So we'll keep watching that. So for a commodity country like Canada, want to keep watching. Again, on the back of the Saudi surge, the advanced decline data didn't really improve that much, and here we go. Now we're just barely humming along. So when we compare this with, say, the U.S. market advanced decline data, you know, this is up at a much higher level, a lot nicer. Still a bit of a downtrend, no big deal. But the Canadian market is obviously much softer. We just don't have the same sort of power. In terms of the net new highs, what we see here is we've gone back for 2.5 years and we just can't get above 50 net new highs, which is just crazy, a relatively soft market. But we're still making higher highs and higher lows here, so we want to keep monitoring that, but I don't see overall weakness. Canada reported a really weak job number on Friday, so that was a little bit scary. And then when we look at the, this is the Alexander Elder method for calculating new highs minus new lows, and he uses a 5-day average. And what you see here is we're still very positive, and it's not quite as whippy as the other calculations where I was using an 8-period moving average or whatever. The way he calculates this is the 5-day running total. So that kind of smooths it out a little differently, but it still works very well. What you can see is when this is black, it's still very bullish. So when it drops into the red here, that's can notably change the market. 1, 2, and 3. All of those were in red zone. We're up at 500 right now, so things are still pretty bullish. I think the Mclellan Oscillators right now are particularly interesting, and one of the reasons for that is it has pulled back gently here. As long as we stay above this 400 level on the Summation index, this is still pretty bullish. So I'm not expecting that to change a whole bunch. And here's what that 400 level looks like on a longer time frame. So maybe if I just go down here and put a horizontal line, I have this one at minus 700. Yeah, so let's put it at 400. No, minus 400, just 400. And what you see on here is back in 2015 when we kind of topped out, we struggled once we started breaking down below 400. That was an important place to watch. I still see the data being a little stronger than that. You can see back in 08, we never got above 400. So that was an area. And even in 2011, kind of whittled down till we couldn't stay above 400. So I'd say we're close to that area, but we still haven't broken down yet. Nick can oscillate around here for a while. It went almost, 6 months up in here in 2015 before ultimately falling down. So I'm watching, but my breadth indicators are still pretty strong. So I don't have a reason to hit sell. So when I say the breadth indicators, part of that is those advanced decline line data and the net new high data, but we also have the bullish percent indexes, and I'll just finish up with the Nasdaq Summation Index here. For the Nasdaq, it's this 200 level, and really when the Nasdaq goes below zero, maybe even minus 200, that's when you kind of see the real weakness. And at the end of 2018 there, what we saw was this big drop from about zero, and we've oscillated back and forth around there, but we're up above 200 right now. That's still pretty bullish, and in 2015 this is kind of where we stranded at the highs and then rolled over. So as long as our breadth is strong, but as you can see we don't seem to be making much more progress, so we just want to keep monitoring the breadth and make sure it stays strong. Until we see any sort of change in that, everything looks relatively good. You still have to pick your industry groups, but things are working pretty good. We have two other ways to calculate breadth, and one of those is the percentage of stocks that are on a buy signal. And we're up around 60%. That's still very bullish. And if you look at the percentage of stocks above the 200-day moving average, we're around 50%, 53% still bullish. So everything is good on the Nasdaq Composite. And just to compare, that number was around 40% at the end of October, or not October, but September. We were quite low, and then we literally kicked it up, and it's been a really nice acceleration now. So, okay, looking at the Nasdaq 100, what we see here is we're up above 75. This is extremely bullish. It can stay up here for 6 months, a year, and we have the Fed kind of easing right now with interest rates. They're doing some QE. They don't want to call it QE, they want to call it something different, but they're raising their balance sheet. So what we see here is, everything is bullish. We're up around 73% of the stocks are above their 200-day moving average. We were down around 42% at the beginning of October. So this is a much better place to be more confident in the market when everything is high. For the New York Composite, we're up around 63%, not quite as high as I would like. I would like it a little bit higher, 62%, but we're at 66% for the percentage of stocks above the 200-day moving average. This is still plenty strong, and we can rally for a long period of time at this level. I think if we could see the energy sector and the oil services sector pick up, that might add another 10% here, but we haven't seen that yet, so we'll keep watching. Crude moved up to $59, so I keep that, to me, suggests there's enough price support there for higher oil services prices and exploration and production company prices. So here's the S&P 500. And again, the bullish percent index, the percentage of stocks that are on a buy signal on the P&F chart, this is up around 72%, very bullish. Anywhere between these two red lines, I'm happy, and we're clearly well above that. And I'd like to be above 65% here. We're up around 75%. That's still bullish. Now, we've topped out there 3 or 4 times this year, but we're still climbing up here. Things look relatively strong. And again, my breadth indicators in terms of percentage of stocks are all high, so I don't see any reason to expect weakness short term. The Canadian market is one of the highest levels we've seen in almost 2 years. We're up over 70% of the stocks are on a buy signal, and we have 70% of the stocks above their 200-day moving average. So again, this level, we briefly hit it here in September, but we've spent 2 weeks back to back here, and again, the whole oil sector's bombed out. So if this was going to start to accelerate from here, this would probably really give a good thrust to the Canadian market. Okay, so that was kind of the breadth indicators that I wanted to cover off. I have some other things that are starting to show up on the charts, and the one thing that I think is particularly interesting this month is the bond charts. And I don't want to cover them all the time, but I think they're particularly finicky right here as they try to come off the low. So maybe just work through these with me and you'll see what I mean. So this is the high yield, and I've taken out the dividend payment so the chart will look different than another high yield chart because it doesn't have the yield coming. Normally that's added back into these charts. But what we see here, the stock is just kind of hovering sideways right around its 40-week moving average, and we wouldn't want to see it go below that, right? In early 2018, that's the kind of thing we saw. So as long as we can hold up above the 40-week moving average, that's bullish. We still have a little bit of space. This scale's pretty fine. We're only 86.66 to 86.95. Want to keep watching that and just see if it starts to weaken at all. But so far, that level looks good. Looking at the 7 to 10-year bonds, what we see here is they've been running up. Obviously, the price has been running up, the yield has been dropping, and now we're seeing the opposite where the yield is starting to rise and the price is starting to drop. And so here we're making a series of lower highs and lower lows, and we finished the week rolling over again on that good jobs number on Friday. So we'll continue to watch this and just see if it keeps dropping down here. So the high yield is still underperforming the price of the 7 to 10-year treasury, and normally it's just more bullish when it's outperforming. So currently we still have this downtrend in the high yield underperforming. I do like the fact it started to break this 3-year trend line on momentum, and perhaps if we can get above zero here, this will start to push up above its 40-week moving average, and that would make this chart a lot more bullish. So we'd be happy to see that. Okay, for the Lqd corporate bonds, again, this is just jogging sideways, no real action here. If we start to lose price support on this, this is one of the places that Jeff Gunlach and Paul Tudor Jones, that's who PTJ is, if they start to see some problems in the market, they're expecting it in the corporate bond market. So that'll be an important chart in 2020. Here's TLT, and again, we had this big uptrend, we broke it, came rallying back up and have now failed. This looks very supportive for lower prices in bonds, higher interest rates in bonds, and with that, we would expect that money should start rotating out of the bond market and probably even more into the equity market as we're starting to break out here. So this is, I still think we have lots of bullish space ahead on the equity market. Here's the MYI. This is a municipal bond, and I try to use it to help me find the direction of the 10-year. Right now it's just jogging sideways, but it too has broken its uptrend, and we'll just keep watching it for softness or whatever. But if people start to sell these off, that's usually when they're moving into more aggressive and out of more safety. So we want to stay, we want to see this chart actually, when it's in decline mode, that's more bullish for us. And in this particular case here in 2019, I don't know that I said that right. In 2019, as it rallied with the stock market rally, so we're continuing to watch this. But again, municipal bond funds, when they start to underperform, what that tells us is the interest rate is rising, and I use this to help me with the interest rate. So here's the 10-year, and what we see on the 10-year is this chart is consolidating sideways for 3 or 4 months here on a monthly chart. We only have 1 week for December so far, but last month we closed here in November, we opened slightly lower, tested higher, and closed a little below the middle of the bar. So far this month, we opened higher, tested lower, and are now higher again. So if we're going to keep going here on this is the yield, so this is the interest rate. So we're expecting interest rates to keep climbing here, and we'll see if that's going to start to happen. On the 10-year itself, this was the outside bar we got last week. So we had an inside bar and now followed by an outside bar. That's pretty bullish. And the reason that is this was an indecisive bar, didn't make lower lows or higher highs. And then all of a sudden this week we come out and we test lower, we open higher, test lower, and close higher, suggesting to me that this wants to push up. So we'll watch for it to get back up around this 2% and then see if we can get through those previous highs. And that's also where the 40-week moving average is. So that's kind of the trend that I would expect over the next couple of weeks. For the 5-year, what we see here is it's been grinding sideways for the last few months. This is a daily chart. But if this was to start to push up, that's what we would expect. And again, the banks actually ground sideways while these interest rates were dropping, and they're starting to push higher here. And the KBE made a higher high on Friday, or the highest closing high it has in quite a while. So the banks still continue to want to push higher, and that chart should help support that. Okay, the 2-year. So we started with the 10, the 5, now the 2. And what we see on the 2-year is it's basically that same consolidation that we saw on the 5-year, and it's trying to turn up a little bit. I could show that chart actually. Let me just go back. This is the interest rates that have been dropping for years, and so we had this big run up off the 2012 area, and now we came up here, and last year we made our highs, and this year we've made lower highs. And so we're watching to see where this ends up falling. But what we would expect, again, this is your yield. So as the interest rate falls, price rises. So does this fall, or do we actually turn around and start heading higher? And that tells us that we've actually kind of changed this big major trend in interest rates. Okay, so this is the picture for the 2-year, the same chart that we just had, and you can see this big uptrend. What we want to watch on this uptrend is, does it bounce off this line and start heading back higher? So that would give us higher interest rates. So after we had this drop in here, we all got concerned. I will say that from my PPO momentum perspective on this chart, if it got up to this red line and stalled here, that would not be a surprise. But we still have some ways to go there, so that we could still have a big bullish bounce. And I've got a note in here that back in 2001 we had the same sort of thing. And my point was, we kind of wiggled down here to this -10 level, and all of a sudden had this huge reversal, and interest rates popped, and so did the stock market. We had a big bounce in here. So, and that was off the back of 9/11, I think. But as we came off the bottom there, that was a really huge reversal. So let's just see how far this goes and see if we come up and then roll back over and make a lower low. We don't really know yet, but we'll keep watching it and just see which way this wants to go. In the short term, it looks to me like the interest rates want to go higher, price lower. So, yeah, okay, enough 2-year. The one question that came up this week was that the 5-year, or the 3-month yield, so again, yield, not price, all of these so far have been in yield. And what we see is the yield is working its way lower, whereas the other ones were kind of pushing towards the upside. So it's interesting that the short-term interest rate, the yield was going lower and the price was going higher. So this is kind of an opposite behavior. Now I have one chart where maybe I'll just show you the 30-year at the same time. And what we see on the 30-year, this is a weekly chart. We have this downtrend, and we got up to it and we pulled back, and now the real question is, does it have enough power to actually push through? And so that would mark a major change in trend here. And my previous charts in this area for the bond picture, this is the 30-year bond price, so it's opposite the yield. But what we want to talk about here is we got up to a very high level and we're starting to fall away. One of the things we notice from these really high levels in momentum is when they fall away, they can move pretty much all the way back to the other side of the range, or at least to 0. So we've fallen from 3 down to 1 here, so we could still go another ways before this would even historically, before this even pauses. So this is an interesting chart just to guide us as to which direction this wants to go. So we're still watching bond price fall, and then we'd watch the bond yields rise. Okay, so let's go look at this chart, the spread. And one of the things about the spread chart, so what this chart is very simply the 30-year, the 10-year, the 5-year, the 3, 2, and 1. And not the blue 3-month that I had before. And the reason for that is when I add the 3-month, I could do that. But what you'll see here is when I add this, it got really messed up in the, I just need a different color here. I suppose black is the regular one, so maybe I'll go with cyan. One of the things that you see on the chart, this is what happened during the financial crisis. It plummeted to 0 for an interest rate. And so see how it changed that whole other chart. And it has rolled over quite significantly here. But what we see is that this was really trying times here when this was spiking low, but it doesn't track kind of any of the other regular 1 year, 3 year stuff. So I've taken it off the chart, and it just makes the chart a lot easier to look at. So let's go back to the way it was. And what I want to point out here, we're going to talk a little bit about this chart where the interest rates pinched together and then kind of rolled all through the late 90s like this and pinched up. And then in 2000, the yield curve started to separate. So the 30-year was nice and high, the 10, the 5, the 3, 2, 1. And in this case, this is the 30-year, and there were no new 30-year being let out or supplied by the Treasury. So there was no new price for that. But what you see here is after we started to pinch down, and it was during this pinching process that we have this big breakdown. And then when the bond yield curve starts to normalize, that's the time to watch for more trouble. So this is 2008, and even back in 2001, we saw the same sort of characteristic. So when we zoom in on the end of this, maybe even more. Let me just make this 2016. And there's a reason I want to make this so tight. But the point that I would say that happened this week for the first time since this whole yield curve inversion, and again, the inversion was when this blue line and the red line started to go above the brown line. So back in this area here. What happens after that is you start to normalize. So the yield curve goes back to that regular spread. And what we see here is here's the 30-year, the 10-year, the 5, 3, 2, and 1. And what we're actually at for the first time since way back here a year ago is we're into the normalized yield curve where they're in the proper sort order for the first time in a long time. So I think that might be significant. And if these charts we're going to expand out again, that could be very bullish, right? That would be normalizing the yield curve. That would be fine. It's also after the yield curve normalizes that we start to see, in 2008, we saw this spread back out again. And while it was spreading out, the stock market was still falling. So this is the first week of normal. And now the real question is, where do we go from here? And obviously, all of my indicators are still bullish, so I'm still expecting higher prices. And when they start to weaken, then I'd be more concerned. But so far, I don't have that. So from a bond market perspective, I think the big thing that I'm expecting over the next few weeks, months, is more where the yield goes higher, the price goes lower, the stock market stays buoyant, and things are looking up from that perspective. Hopefully, I made that clear. So all that adds up together to say that this market, in my opinion, still looks like it's ready to go higher. This was the gap up on Friday, and what it did was it moved right up against the prior highs on the SPY and on the Nasdaq Composite, the QQQ. We didn't quite get as high, but we're testing a prior high. So anytime you're testing a prior high, you should be careful. But I don't have any sort of degradation of breadth here yet. So I still think this is very bullish, and we want to keep watching the stock market for potential problems. But right now, it looks like investors bought the dip and took it right back up again after a 2 or 3% pullback. So this is still very much an uptrend. So with that, thanks for taking the time to join me. I do want to say sorry if you were looking for my work throughout November while I was traveling, but hopefully we're back at it, and you can enjoy some videos for the next few months now. Thanks, everybody. Bye-bye.